Hey, folks, welcome back to Money and Politics. It's December 21, and it is finally officially the first day of winter. So, hope you're staying warm wherever you are. I'm going to go over a couple of things tonight. One thing I wanted to say just right off the top, or I'll forget. 2021 has been both a weird year and kind of an amazing year for me, and an amazing year for me, and I would say Thomas as well, and maybe for you all, because of Humble, because of me starting this channel. And as I've said to you all, and I've said actually even personally to Brian when I met him, over the 40 years of me buying stocks, I never had a sense of community like we have in Humble. Now, I know a lot of people are disappointed in Humble, and it's understandable that they're putting good money into the stock, thinking that they're going to get a fantastic rate of return in short order. And that worked for a while in the beginning, but then it went away back in February, so it didn't last very long. And we've been going downhill predominantly ever since, with aside from a few hiccups. It is not for nothing that I've said before, I never bought OTC stocks. And we all know, or you could all understand without me going into all the details, why, when you look at all the market manipulation and different things that are on the OTC, that are not on other platforms. Now, that said, I've said for a long time that I didn't look at Humble as an OTC stock. I looked at it as more of a substantive company. And, I still think that that's yet to be proven, but I think we're on the way there. So yesterday we had the ACH improvement on mobile, and today there's a nice little thing. This isn't mind-blowingly significant, but it is a nice change that Doug Brandt and his group of guys at Monster Studios have won the Clio Awards, some Clio Awards, and it says that the company announced today that it has won 2 awards in the 2021 Clio competition, as well as 1 nomination. The 2021 version of the esteemed awards show saw Monster Creative secure wins for theatrical trailer, with the action adventure 6 Underground, and they won silver in that. And the documentary Val, based on the life of Val Kilmer, they won bronze there. And nominated theatrical partnership branded content. So I actually watched the Val interview, or documentary. It's pretty interesting. What does this mean? The thing is, it's not going to do anything to be moving the stock price, but it is, I think, an indication, at least, that when Brian went out, I had never heard of Monster before. I mean, because it was kind of more known within the Hollywood industry and theatrical industry. But it goes to show that Brian, when he went out looking for a studio, bought a very talented group, a very, talented group of people who were a part of Monster. And Doug is now running that. He's running it for Humble, and Monster Creative is a Humble company, as the release said. So, when you look for the future of Humble, you want to make sure that you got someone who's not just out there buying things that are not really things that you want to be buying, and I think that's some indication for Brian doing the job well in that sense. Now, what else? The market came back today, and as I was saying, I think that, and I even tweeted today, that in the last couple of days I was saying that InMode, which had been up to near $100 back at the beginning of November, it had fallen down to about $63. Today it bounced back a bit. It came back to $70.41. That's a 6.57% gain. And I think that again, this is a company that I think is you want to be having. And if you at $70, maybe you can buy some shares. But if you can't buy some fractional shares, if you can't buy outright, I did say that I think when the fourth quarter ends at the end of this month, I think that they're going to have that end of year, the full year earnings report will be coming out around, I would say, Valentine's Day. And I'm saying that I think they're going to have record revenues and record profits. Record revenues and record profits. I am going to predict they're going to have $350 million for the 2021 year, and that they would have profits. This is my crystal ball, folks. When don't say I promised you this. This is my crystal ball. Take it for what you will. It's a guesstimate, and I would say that their profits would be north of $100 million. They did $75 million last year, so it's a very strong company. Now, that said, I'm just trying to clear up the desk here a little bit. Whoops. All right. What I wanted to say is my mouse is freezing up. I thought it would be kind of fun to look at how the year has gone for a variety of things. And so here we have in red, which I always use as the baseline, that's the S&P 500. And you can see it's up 23.85%, so virtually 24%. The blue is Trade Desk, ticker symbol Tom David, TTD, so that's in blue. And you can see how volatile that is with the ups and downs. It's good when you're looking to buy some of these companies, any company, not just the ones I have on the screen here. Look at their patterns. Look, are they very volatile or are they not? And you can see how volatile Trade Desk is in blue. And by the way, I will remind you that did a 10-for-1 split this year. It went from $600 down to about $63. I had been following it for a while, and I bought it at $63. And today it is what I think it closed at $93.53. But the point I'm making here, let me highlight that so you can see the blue. That's Trade Desk, and you can see the volatility. So number one, you're going to know what you're getting into. And number two, you can see where some of the support lines are, depending upon how long you want to hold it. In other words, if you're going to be buying it and holding it for, 3-5 years or more, then the support lines here are not necessarily important to you. But if you're looking to do some trading in and out of it, you would want to know that. So it depends what your game plan is. Anyway, I wanted to not spend all my time on that, but in blue we have Trade Desk. The other thing is you look at some of these companies and people will go, oh man, Amazon, oh, how I'd love to have Amazon. But, look at Amazon. Year to date, Amazon is up only 4.65%. And there's another lesson there that I want to discuss. When you get to be as big as Amazon, and it has the same problem now, I would say virtually the same problem, not quite, as Coca-Cola. It's so big, it just is almost impossible to get those shares to move very much. Now, let me move the cursor here on the green line, and the green line is, as I say, that's Amazon. So if we start off and go back to March 25 of this year, Amazon was at $3,075 in March 25. Now you go up to July the 8th, and so that's, 4 months later, it's at $3,700. So, by even buying one share, you could have made about $700 there. Here, let's back in early March, it was right around $3,000. So by July, you could have been up $700 on one share. Now, that one share was going to cost you, like I say, about $3,000. Now, that's what, about a 20%, a little more than 20% move. $600 would have been a 20% move. And so you might say, well, yeah, I don't have $3,000. This is where I'm telling you, you can buy fractional shares. A 20% or more, let's call it 25% for the sake of discussion. A 25% move is a 25% move whether you have one share or whether you have a fractional share. So, you know, this is the advantage of investing in some of those fractional shares. And then we have the S&P 500. Now, a lot of people poo-poo the S&P 500. I would say you want to know what the S&P is doing even if you don't buy the S&P per se, because that is the benchmark. And in 2021, as you can see, it's had a great year. A 24% move on the S&P is phenomenal. So that was dang good. And when we then throw in the NASDAQ, let me see if I can make that kind of a light, let's call that mauve. So there you go. I'm going to take Amazon out of here just because we know that underperformed. So there you go. The NASDAQ uncharacteristically this year underperformed the S&P 500, but you can see how close they were connected. And, you know, there you go. Now, let's put in some of the other things that we've talked about. Let's put in InMode, I-N, M as in Mary, D as in David, InMode. And I'm going to make that gold because it's the golden boy. Boom. And this is why I talk about InMode, because this year, going back in January, it's up 346%. I apologize. That's, as I've said so many times, it gets to be so small on my screen when I'm doing this that it's hard to sometimes read those numbers. It's actually 196%. I'm sorry. But you can also see how it's come down, as that's what I was talking about. It has come down over the last 6 weeks or so, where it was up about 300%. It is up now just under 200%. Again, I think that is a stock to buy, and I think that this downdraft that we've had of late is a buying opportunity. As always, I would not go in and just throw all my money in at one time. I would recommend you buy InMode for the next 3 years. So just, you know, buy some, buy some, buy some. If it fits into your portfolio, if it's something that you want to do, if you can, you know, handle some of the ups and downs, and you can see too that is somewhat volatile. Now, let me go ahead and add a few more things just so we can see. And obviously, before we go too far here, HMBL, we'll add in Humble for the sake of discussion. And because I would like to know, as we go further into 2022, maybe we can remember this and see how Humble did in the future here in 2022 as compared to 2021, which is why I kind of wanted to do this year in review. I must have too many things open because my cursor is just not cooperating with me. It's sorry. All right, so we have you can see how it shot up, and in the beginning of the year, Humble. And where it was way up, it is down from the beginning of the year, now down 34.5%, which seems like, oh my gosh, it should be down more than that. I know some of you are down 80%, maybe more. It depends upon when you bought. But again, this was the startup year, and you can see graphically the emotional buying that we had in the beginning of the year. You can see certainly as I've talked about before, this parabolic rise. And as I said in the past year, as a reminder, and we get some new people who haven't heard me before, that when you get a parabolic rise like that green line in the beginning, it's like an F-16. It can go up for a while, but it can't keep going up that way. You can't take an F-16 to the moon. And so when you get a parabolic rise, you're going to get almost a mirror image on the downside. So that's one of the lessons I've been hitting on this year. So I would keep that in mind. That's something you can take with you. And also you want to put in, if someone tells you to buy something, compare it to the S&P 500. Let me take Humble out of here just because it gets to be a little confusing when you get too many things in there. So, in fact, let me take the NASDAQ. Well, let me leave it in there. And then the other thing, which I've said so many times before, and this is what I would recommend for a lot of you, if you don't want to put, you want to be diversified, you don't necessarily want to have all your or too much money into one company, then buy these leveraged ETFs. And when we have the UPRO, let's just see how that is done. The 3 times the, let's make it kind of a gray here. The UPRO, 3 times the S&P 500, and you can see that's up year to date about 84%, where the underlying index, the S&P, is up 24%. So you got 60 points more by buying the UPRO, and the NASDAQ is about under the S&P, so it's around 22% or so. We're going to look at the TQQQ, which is also one of my favorites, but again, I'm going to repeat myself. You have to, you run out of colors here. I wish they would add more colors. Let's go kind of fire engine route, I guess. Let me momentarily take the INMD out. And because this is one of the odd years where the NASDAQ underperformed the S&P on the triple leverage version, you have the S&P up 84% and the triple version of the NASDAQ up 70, but close to 72%. On the other hand, if we move past this year and look at the same returns, but over a 2-year period, you see that now the triple version of the NASDAQ, the TQQQ, is up on top with 243.6% gain over 2 years, followed closely by Trade Desk. And then we go down 93% over 2 years for the UPRO, and then we have the NASDAQ by itself at 67.8% and the S&P at 44.34. So if you take the S&P as our baseline of performance over 2 years, that's right at about 22%. And again, look how much more the TQQQ is doing, at 243%. Or Trade Desk. Now, Trade Desk is an individual company. And then let me go back and put in again InMode. And then I'll bring this together for you and kind of say, here's the kind of thing I want you to know. But you got to see this to really understand it. If I was just verbalizing it. So over 2 years now, InMode is up 240%, just about the same as the TQQQ. So when you have individual companies, when you're putting your money into individual companies, you want to, pick those carefully. Don't just be throwing darts at a board, because your alternatives are that you can buy the leveraged versions of the NASDAQ and the leveraged versions of the S&P 500. And you can buy the leveraged version, which I rarely talk about. I'm not as fond of it, but of the Dow 30, the triple version of the Dow is UDOW. And let's see if we can, what the heck color is left? Maybe a nice purple. And that's why I don't buy the triple. Let me change this for a minute. I want to make sure I'm looking at the right thing. Yeah, I mean, this is why I don't buy the UDOW. The UDOW over the last 2 years has underperformed just the S&P by itself. So let's take that out of there. We don't need that. So there you go. The red line down below is the S&P 500. The red line on top is the TQQQ. And over a 5-year period, what you see there, as much as InMode wasn't around for 5 years. InMode only started in publicly trading in August of 2019. So we really can't go back much more than 2 years, but you can see that the TQQ did well, InMode did well, but look at the TTD, trade desk, and so that's another one, and that's up 2,800%. So folks, the lesson here, and let me just stick myself in for the side here. The lesson here, when you are trading this, let me see if I can move myself out of the way here. There we go. When you're looking at this, this is why what you want to do on a portfolio is put some stocks into individual businesses, because the individual businesses give you the opportunity to hit a grand slam home run, as we have with Trade Desk. Okay, now that's number one. Number two, I would have as a core of my portfolio those leveraged indexes, where, if the founder of the company dies, I mean, look, how Apple was hurt when Steve Jobs died. So anything can happen, any bad thing can happen to one company. But when you're buying these indexes, you're also diversified greatly. I've said many times, and if you're the first time hearing me, these leverage versions go up 3 times faster and they go down 3 times faster. So you also have to be prepared for the volatility. You have to be prepared for the volatility of a trade desk, and you see that here. But volatility, I have said, contrary to what a lot of stockbrokers would tell you, I would say volatility is your friend, because if you have a good company, and when it goes down, and if the story that you're buying the company for a reason, if the story is still good, then buy it when it goes down. And when you go up, especially if you go up sharply, as we did right here, and this is in the fall, right after COVID, from March to December of 2020, TTD just went skyrocketing. So, at times here, and you see right here in the early November time frame, again, went parabolic. Now, interestingly, it came down a bit, but then bounced up again. So you never know where it's going. You don't know. You have some indications based upon chart patterns. But what I would say is this is where here and there you want to take a couple of shares off your position. Doesn't mean you got to close out your position. A great company like a Trade Desk or like InMode right now, I would keep as a core. And if it shoots up dramatically in the near term, let me take myself out of here for a minute. If it shoots up dramatically in the near term, then what I would do is that's where you want to, take a couple of profits. And then if it falls back from where you sold it, you can buy those shares back to rebuild your position. And, you don't have to. But if you're going to hold it for a long time, then you can build up your number of shares by, taking a little off when you get a sharp peak, as we did here with the yellow line with InMode in early or the middle of September. Now, when we are back and we are down here, let me take some of these other stocks out of here because I want you to focus for a moment on InMode. Where's the blue? Get that out of there. You can see now with the this is the 6-month chart that with InMode here in yellow, we are back to where we were at about September price-wise. This is where I say this is, I think, a buying opportunity. Can I promise you it's going to go higher in the future? No, no one has a crystal ball, but I have a strong conviction myself that InMode is going to go higher for the reasons I already mentioned. I think when it comes out around Valentine's Day, you're going to have record-breaking revenues and record-breaking earnings. Now, it's also possible that they could come out and say, for various reasons, they're changing their guidance downward for the rest of the year, in which case the stock might really fall. But again, my conviction is that this is a company that's going to be growing over the next 3 to 5 years. It doesn't mean that they're not going to have some downdrafts here and there, as we see. And that brings me, I guess, to the last thing I would say tonight, and I'm going much longer than I intended. And the last thing I would say is that when we're investing in the market, not all markets are the same. And sometimes, it's like flying a jet. You're flying a jet across country, and sometimes you got a tailwind, sometimes you got a headwind, sometimes you're getting cross currents. And right now, that's kind of where we are. I think on the market, we got cross currents. We've got this, if I'm saying it right, Omnicom, or the latest version, the variant. We got that going on. We just had one thing I thought was a very good thing over the weekend, and I had mentioned Joe Manchin killing the Build Back Better. I think that was an excellent thing to do for the reasons that Senator Manchin said and that I had talked about earlier. We have a danger of runaway inflation. I'm not saying it's there yet, but we are laying the foundation for runaway inflation, which would be disastrous for the economy and the markets. To have spent trillions of dollars more, like $5 trillion more into this economy when we already have the national debt now at $29 trillion, I think would be exactly the worst thing to do. I don't want to be over the top hyperbolic, but that was a good thing. The latest variant is a bad thing. The good part is that, it's not that bad apparently. But you have to kind of look at the overall market and say, what's going on? What are the threat levels? And I suspect the Democratic leadership will probably try to come back with some kind of an infrastructure deal down the road. We'll see. But for now, this is part and parcel of where we are. We're going to get real political as a nation in 2022. I might do some more politics because it will be a political year, and it depends who's going to run the House, who's going to run the Senate. As of now, as you all probably know, the prediction is that the Republicans would take control, I think, of both House and Senate, and that would mean that it would cut the legs out from President Biden being able to do further bills like the Build Back Better, because he would have to negotiate that with the Republicans in Congress instead of them being sitting on the sidelines with their fingers crossed, hoping that at least one Democratic senator is going to say no, as Senator Manchin did. Anyway, so as I said yesterday, if I asked you what do you think. If there's things you want me to change, let me know. One thing I might do is do some, which I kind of did tonight, but do some more videos on trading techniques and just basic ideas. I don't think you have to get real fancy schmancy, but I think you want to just have some basic fundamentals. And as I said from last January, I really created this for the people who are the new investors, and not that a lot of you are sophisticated, and I appreciate you being with me, but I don't want to be talking over people's heads. There's going to be, I remember when my dad died, my mom didn't, she had some stocks that she inherited, both from my father and from her dad. But she was never, a sophisticated investor. And she probably, with a little bit of guidance from someone who wasn't trying to sell her something, probably could have done a lot better. So that's part of where I'm coming from. I want everyone to get into the market. I want you to understand the risks and the rewards and how to structure our portfolio. And as we have with any number of the companies, as with InMode, as with Humble, as with the Zynex, we are going to be discussing individual stocks as we go along throughout 2022 and beyond. I am getting some requests to look at some things, as always, and so you can do that, and I'll take a look. And I appreciate you bringing them up. Here and there have been some good ones. But for the S&P 500, it's been a good year. For some of the stocks that we have talked about, it's been a mixed bag. Obviously, Humble in closing is not where we want it to be, but I have always said, when we're buying Humble as a growth stock, we want to be talking about it as a growth stock. And in 2021, it was a startup. So we couldn't expect much from that as a startup in 2021. They had to lay the foundation, and they have been. Okay, that said, folks, I'll let you go. I hope to get back to you again before Christmas. I may have a block of time, depending upon how things come, that I can do some more research over the period of time between Christmas and New Year's. I don't know my own plans just yet. I'm trying to see if I can get together with some other folks. But if that doesn't work out, I'll have a block of time to do some research and then hopefully lay a good foundation for us all of us, going into 2022. If by chance I don't talk to you, have a great Christmas. Stay healthy. There are some horrible stories on the news about people getting killed in car accidents and all. So be careful out there, and hopefully we'll see you again tomorrow night. All right? Take care.